If you had put 1,000 pounds into the S&P 500 index 10 years ago and done absolutely nothing with it, no checking, no adjusting, no panic selling, that 1,000 pounds would be worth roughly 3,200 today. You didn't need a financial advisor. You didn't need to understand markets. You didn't need to pick the right stocks or time the perfect entry point. You just needed to start. And then stay out of your own way. The biggest myth about investing is that it's complicated, that it's for people who understand Bloomberg terminals and read the Financial Times over breakfast, that you need a lot of money, a lot of knowledge, or a lot of confidence before you're allowed to begin. None of that is true. And the people who believe it are paying for that belief every single month they don't start. In lost compound growth they will never get back. This video is investing from zero. The basics, the accounts, the funds, the exact steps. Everything you need and nothing you don't. Let's go. This video is for anyone who has been meaning to start investing but keeps putting it off because they don't know where to begin. For anyone who has a savings account earning next to nothing while inflation quietly eats away at it. For anyone who hears words like ISA, index fund, ETF, or compound growth and feels immediately out of their depth. By the end of this video, you will understand what investing actually is, why it matters, which accounts to use in the UK and US, what to actually invest in, and the exact steps to start this week, even if you've never invested a single pound or dollar before. Simple, clear. Let's get into it. Let's start at the very beginning. What is investing? Investing is putting your money to work so that it grows over time. Instead of sitting in an account doing very little, your money is used to buy assets, shares in companies, bonds, property, funds, that have the potential to increase in value and generate income. The alternative, keeping your money in cash savings, is not the safe option most people think it is. Here's why. If your savings account pays 4% interest and inflation is running at 3.5%, your money is growing by 0.5% in real terms. If your savings account pays 1% and inflation is 3.5%, your money is losing purchasing power every single month. In real terms, doing nothing with your money is not neutral. It has a cost. Now, why do most people not invest? The research is clear on this. It isn't lack of money. Studies consistently show that the primary barrier is a feeling of not knowing enough. People are waiting until they understand it better before they start. But understanding investing comes from doing it, not from studying it in theory. The longer you wait to understand it perfectly, the more compound growth you lose while waiting. There is a word for this in behavioral finance. It is called the knowledge paradox. The more you feel you need to know before starting, the less likely you are to ever start. The antidote is simple. Start small. Start now. Learn as you go. You do not need to understand everything before you begin. You need to understand enough. And by the end of this video, you will. Before we talk about accounts and funds, you need to understand one concept, just one. Because once it genuinely clicks, your relationship with time and money will never be the same. It's called compound growth. And here is the simplest version. You invest 1,000 pounds. It grows by 8% in year one. That's 80 pounds. Now you have 1,080 pounds. In year two, the 8% applies to 1,080 pounds, not 1,000 pounds. You earn 86 pounds. Now you have 1,166 pounds. In year three, 8% of 1,166 pounds, and so on. Every year, you're earning returns on your returns. The growth accelerates over time without you doing anything additional. Over 30 years at 8% annual return, that single 1,000 pounds becomes 10,062 pounds. You put in 1,000 pounds. Time and compound growth turned it into over 10,000 pounds. Now add 50 pounds a month on top. Same 30 years. Same 8% return. Your total 1,000 pounds starting point plus 50 pounds a month becomes over 84,000 pounds. Here is the single most important implication of compound growth. Time is the most valuable ingredient. A 25-year-old investing 100 pounds a month will retire with more than a 35-year-old investing 300 pounds a month, purely because of the extra 10 years of compounding. You cannot buy time. You can only stop wasting it. Every month you delay starting investing is a month of compound growth you will never recover. That is not a scare tactic. It is maths. Right, now the practical part. Where does the money actually go? The account you invest in matters enormously, because the right account means your growth is tax-free. The wrong account means HMRC or the IRS takes a share of every gain. Let's cover the UK and US separately. In the UK, your primary account is a Stocks and Shares ISA. You can invest up to £20,000 per tax year. Every penny of growth inside it, dividends, capital gains, interest, is completely tax-free, forever. You never report it to HMRC. It never appears on a tax return. It simply grows untouched. Platforms: Vanguard UK, Invest Engine, and Moneybox are the most popular for beginners. All three have low or zero platform fees on smaller amounts and allow you to start with as little as £1. If you have a workplace pension, that also counts, but a Stocks and Shares ISA gives you flexibility your pension doesn't. You can access it before retirement age. In the US, your primary account is a Roth IRA. You invest after-tax money now, it grows tax-free, and you pay no tax on withdrawal in retirement. You can contribute up to $7,000 per year. Fidelity, Vanguard US, and Charles Schwab all offer Roth IRAs with no minimum deposit and no account fees. Alongside it, if your employer offers a 401k with matching contributions, always contribute enough to receive the full match first. That match is free money and it comes before everything else. UK, Stocks and Shares ISA. US, Roth IRA plus 401k match. Open them this week. The account is the foundation. Everything else sits inside it. You've got the account. Now what goes inside it? For a beginner, the answer is almost always the same: a low-cost global index fund. Let me explain what that means and why. An index fund is a fund that tracks an index, a collection of companies. The S&P 500 index, for example, contains the 500 biggest companies in the US. An S&P 500 index fund buys a small piece of all 500 of them. When you buy the fund, you instantly own a tiny slice of Apple, Microsoft, Amazon, Google, and 496 others. One purchase. Instant diversification. A global index fund does the same thing, but across the whole world. Thousands of companies across dozens of countries. Even more diversification. Even less risk tied to any single company or economy. Why index funds rather than picking individual stocks? Because the evidence is overwhelming. Over any 10-year period, more than 80% of professional fund managers, people who do this full-time with teams of analysts and billions of pounds, fail to beat a simple index fund. You, as a beginner, are not going to outpick the market, and you don't need to. The index fund gives you the market return, and the market return, over time, is extraordinary. What to buy in the UK? Vanguard FTSE All-World Accumulation Fund, ticker VWRP. In the US, Fidelity Zero Total Market Index Fund, FZROX, or Vanguard Total World Stock ETF, VT. Low cost, diversified, automated. That's the entire strategy. Let's make this completely actionable. Here are the exact steps to start investing this week from zero. Step 1. Make sure you have an emergency fund first. 3 months of essential expenses in a separate, accessible savings account. Do not invest money you might need in the next 3 years. This is the foundation that lets you stay invested when the market falls, and it will fall. Step 2. Open your account. UK, a Stocks and Shares ISA on Vanguard UK, Invest Engine, or Moneybox. Takes 15 minutes online. US, a Roth IRA on Fidelity, Vanguard US, or Charles Schwab. Also 15 minutes. Also free. Step 3. Invest your money into one global index fund. UK, VWRP on Vanguard. US, FZROX on Fidelity, or VT on any platform that carries it. Step 4. Set up a monthly direct debit or automatic contribution. Even £25 or $25. Automate it so it happens without a decision. This is the step that most beginners skip, and it's the step that makes the most difference over 10 years. Step 5. Leave it alone. Do not check it every day. Do not sell when it falls. It will fall. It will also recover. Every single time in history, it has recovered and gone on to new highs. Your only job is to stay in your seat. 5 steps. A 15-minute account opening, and time doing everything else. Investing is not complicated. The financial industry wants you to think it is, because complexity justifies fees. The truth is that a beginner with a stocks and shares ISA or Roth IRA, a single global index fund, and a monthly automatic contribution will outperform the majority of actively managed funds over a 10-year period. Simple beats complex. Time beats timing. Starting beats waiting. You now have everything you need: the account, the fund, the steps. The only thing left is to do it. Now, drop a comment and tell me honestly, are you already investing, or is this the video that's finally going to make you start? And if you've been investing for a while, tell me what you're invested in. I want to know where people actually are with this. I read every single comment on this channel, and the answers to this question are going to shape what investing content I make next. So tell me, investing yes, investing no, or investing soon? Share this with someone who keeps saying they'll start investing someday. Someday has a date now. It's this week. I'm Charlie. New video every Thursday. See you then.